Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew, and this is an earnings conversation. We're speaking with the management of Gokaldas Exports. I've got with me Mr. Sivaramakrishnan Ganapathi, who is the Vice Chairman and Managing Director of the company. Thank you so much, Mr. Ganapathi, for taking the time. And I won't jump straight into the numbers because I want you to provide a little bit of context. If I look at the headline number for FY23, there's 24% growth in revenue, and there's a 50% plus growth in PAT. But that doesn't tell the whole story. If I look closer at the quarter numbers, then I see that what you've been speaking about in terms of the demand trends has in fact continued to play out. So my first question to you is to lay the context for us to help us understand whether the demand trends you were seeing at the end of the third quarter have panned out as you expected, or are they in fact worse than you anticipated?
No, they're going as expected. So if you look at our third quarter and fourth quarter, you would have seen that our revenue numbers were somewhat muted at around 530 crores. So we've done what we've done. We've done our best given the market conditions, and we had called this out long back that second half of FY23 is going to be difficult, and so would the first half of FY24. So it's in a way playing to a script. And I would still hold that what we are seeing is primarily on account of slow market conditions in the Western world, which is both North America and Europe, which are principal markets for us. The situation that is obtaining there is that the brands are seeing sluggish demands from end consumers because of high interest rates, disposable income coming under pressure, and all of that, as well as them sitting with excess inventory. Many of the brands have started clearing out or have cleared out their excess inventory and have brought it down to considerably lower levels. And we are hoping that it must be reaching at they would have right sized the inventory, so to speak. The end user demand still has to pick up, and until then, I don't think brands would be really going forward and buying significantly. So we will continue to see a bit of sluggish demand in the quarters ahead, at least 2 quarters ahead. I'm anticipating that come 2024, we should start seeing an upward trajectory, and that would have a positive impact on our growth from the third quarter onwards. We, as usual, will continue to gain market share from the rest of the supplier base and try to still hold on to our revenues at these levels, and hopefully then set ourselves up for a surge in growth subsequently. So that's the broad narrative, and that's exactly it's playing out as per that theme.
Sir, for those that are not familiar with the entire picture of the way that you operate, you're an exporter of apparels, but just to give people a little more understanding, US is your primary market, but would you be able to break it down for us in terms of the geographical spread from where you export to?
So bulk of our exports go to North America, about 83%, and within North America, between 75 to 78% would be to United States. Europe forms, the share of Europe is under 5% for now, and all the other continents, whether it is Africa, Australia, would all be 1-2%. And Asia would be the rest, which is about 10-15%. So that's the kind of broad spread that we have across the world. So North America and primarily US is our core market.
Understood. So that provides context, which leads me to the next question. You're anticipating that demand trends are going to be slightly sluggish in the first half, and by my understanding, when you spoke to Neeraj the last time, you spoke about capacity utilization being 10 to 12% lower than peak.
Right.
Does that continue to be the case? And I'm asking because you have capacities coming on stream. You have Madhya Pradesh that comes on stream in the first quarter itself. I believe that you have another knitting unit that you're building in Tamil Nadu. With all of this, are you pushing back ramping up of capacity just a tad bit? Will you go easy on Capex? I know the Bangladesh plan is on hold for now, right?
Right, that's right. So the Madhya Pradesh unit, is on, and we will be ramping up, but we'll be ramping up slowly so that we set the unit up. The training has more or less happened. We have started with small orders, so you know it will go through a gradual progression till we start an aggressive ramp up. The Tamil Nadu unit is expected to go on stream sometime towards the end of second quarter or early third quarter. I guess by then, more or less, the market condition should be better than what it is now, and it'll be the right time to launch that unit. So we're not shying away from capacity building, and one of the reasons is that we are very confident of our position in the marketplace. We're very confident of how the brands who buy from us view us, and they have seen that we have an impeccable execution. So when the demand really picks up, we should be in a very, very strong position. Our customers are backing us up. We have, in fact, added a few customers very recently. So all of that is giving me the confidence that, you know, regardless of the market conditions, I think we are on a strong footing here.
If we put that in numbers, as I look at your analyst presentation for the last quarter, you'd anticipated slightly upwards of 60 crore rupees as capex for the fourth quarter. What number did you actually hit? And also, if you put that forward to the next year, I believe in FY24, you were anticipating some 85-90 crore of capex in a variety of things. Does that reduce now?
No, we are holding on to all our capex plans. So we're not altering our capex plan at the moment.
Okay, fair enough. Let me move to the margin picture, because this is again something that you have spoken about, and indeed what you have said that you're doing in terms of driving operational efficiency at times when the market is sluggish has panned out. EBITDA margin in the fourth quarter standing at 14.5% or thereabouts, and that is an expansion sequentially as well as on year. For the full year as well, you've achieved better than the previous year, FY22. What is leading to that? Is it simply operational efficiency, or is it also in the end of the year, have you seen costs reduce? I see as a percentage of revenue from operations, your raw material costs have reduced quite substantially on a year-on-year basis. Freight costs as well are coming down. So can you give us a kind of a holistic picture of how margins are panning out?
Sure. So if you actually parse our margins YOY, you would find that, you know, it's actually grown by 2%, not 1%. The reason is that last year we did not have ESOP charges included in last year's EBITDA margins. If you look at this year, we have taken an additional 23 crores of ESOP charges. So you know, if I adjust for that, like operationally, we have improved our margins. Now, there are a few reasons for this. One, of course, we have become far more efficient. The raw material prices have gone down as well. We manage our capacities really well. So all of these have actually led to that margin growth. We hope to hold on to it. There are headwinds, as I said. You know, whenever there is a demand-supply mismatch and demand is lower than supply globally, there would always be margin pressure. It is partially alleviated by the fact that raw material prices have come down. So you know, we have been able to push back some of the cost of raw material back to the suppliers, and hence hold on to our margins. It will be a difficult task, but we are operating very, very efficiently, and we'll try to hold on to the margins.
So around 14% is what you're aiming
at?
No,
14% was for the quarter, and I don't think that, that is the right benchmark. The annual benchmark is a more accurate benchmark. What happens is there are certain provisions which we take. We are very conservative in our accounting, for gratuity, etc., which we over provided in the first 3 quarters. So we had the adjustments which happened in the fourth quarter, which resulted in a spike in the fourth quarter. But take the annual EBITDA margins, which is a more realistic benchmark for progression going forward.
At the cost of repetition, and just to close out this conversation, just to reiterate the point, first half you're anticipating just a bit of a sluggish growth, but the trajectory that you've seen in revenue, 500 plus or closer to 520 crore, is what you think is achievable. And with the Tamil Nadu unit coming on stream, an additional 60 crore for the year is what you're anticipating, most of that coming in the second half. Could you give us a holistic picture?
So the first half, as I said, would be at the current levels, current quarterly run rate levels, and in the second half we are hoping to pick up the new unit. Hopefully, will add 60 crores for the year. The new Madhya Pradesh unit, that's the expectation, and the Tamil Nadu unit will contribute to some revenue. Its ramp up will happen in FY25. So in FY24, the contribution may be just modest, given that it's going to be launched in literally in the beginning of the third quarter of this year. So my sense is that we're still targeting a growth in FY24 over FY23 with all of this. We would all like a strong growth, but unfortunately, given the economic situation, it's hard for me to pin a number at this point in time. We are all not experts in predicting how global economies will shape up in the next 12 months. But I'm fairly hopeful, regardless of how those things happen, we will still do well, given that we will still take share from competition.
Fantastic. Shiva, thank you so much for taking the time. Pleasure speaking with you as always, and look forward to the next conversation.
Thank you so much, Alex. Really appreciate it.
All right. Viewers, do stay tuned. Lots more coming up over the course of the day. This is BQ Prime.